Welcome to TheoTrade. This is Don Kaufman, August 28th, 2021, doing the TheoTrade weekend update here on a Saturday morning. Well, wow, was that a game-changing rally in the markets? Or really, does it just break down to much more of some of the same upside activity that we've seen? That and much more here on this weekend's update. We're also going to talk expressly about some very unique trade opportunities that are presenting themselves. Let's get to work and kind of kick it off here talking about this prior week where, well, once again, the Fed, Jerome Powell, comes out and just ignites an absolute rippin' rally on what was really a dovish tone. Before I go any further about that, I mean, really not much materialized out of the Jackson Hole Symposium other than Jerome Powell did not say the word taper, and the markets loved it. But to what extent? There is one aspect that is missed out of this rippin' rally, and this is kind of a crazy chart that I wanted to start with. And the reason I wanted to start with what I kind of call a crazy chart, you know, the market was open right in this neighborhood here. You wouldn't know it. The markets just stalled. They didn't do anything. They stagnated. He didn't say anything. The marketplace took off to the upside. But the point, okay, of me bringing this up is not to show necessarily the upward momentum of the marketplace. It's actually going to be to display the efficiency of the marketplace. So Jerome Powell comes out, you know, sees his shadow, maybe 6 more weeks of of winter. We'll hear more taper talk later on. But when I talk about, like, you know, what was important, okay, it's right here. It's the SPX. All right. The marketplace and the efficiency of the marketplace drove the SPX right to the upper edge of the expected move. And that's all we did throughout the course of the day. You know, people are, it's a rippin' rally, it's this, it's that. You know, it is not at this point a game-changing rally. And that's actually one of the things I wanted to throw in here right up front. There's nothing game-changing about a marketplace that does precisely what it was supposed to. And that's why I wanted to start with this, is because the level of efficiency in a marketplace, okay, it means everything. You know, is this a game-changing rally? Absolutely, unequivocally not. The marketplace was already gearing towards the upside. In fact, on Wednesday night's video, we even talked about, you know, hitting the upper edge of the expected move, and that was a very likely inflection point for the markets. And the irony is, again, these expected moves, which are drawn, you know, the week prior, all right, we tagged it. I mean, when I say we tagged it, we literally ended to the penny, people. You look at this, it's a $4,500 product, and the SPX actually hits it right on. I mean, it's 45.09, and that's effectively where we closed the marketplace. So when we look at the idea of a game-changing rally, you know, just looking at the S&Ps, you're like, oh, this is just a game changer. You know, it's no taper talk over here. And then, of course, you take a look at the 1 minute, and it was an explosive move. But again, it's precisely what the marketplace was pricing in. Something that be game changing would be like a 2 deviation move, if you will, outside of the expected. And that's one of the first things I wanted to start with here on this weekend's update is this is very much, you know, it's what we kind of call par for the course. And I'll tell you what, next week's volatility got crushed down. So sure, Jerome Powell did ignite a little bit of that rally, of course, on Friday morning. I found it interesting that the bonds, they didn't really play a role. And it's one thing that just continues to kind of resonate with me, is that the bonds have not played a role, of course, in any of the Fed speak lately. To kind of accentuate this, you know, I'll bring up the 1 day, 1 minute right here inside of the ZB, and you can see, you know, it's a bit of a conversation piece, a little bit of volatility and chop in here, maybe some volume picked up, but net, okay, the marketplace was just met with buy-side activity, and that is to the equity and index marketplace. Bonds did not play a role. one of the reasons I suppose that was, the role of the bonds is currently in play. And there is, to a larger degree, a lot of research done that the bonds don't do very much during the period of their roll. Well, that roll is over and done with. We're pretty much going to be out of SEP and trading DEES early next week, of course. So the roll is over and done with. You can see the volume inside of the ZB as the roll is going on, perpetuating itself. Nevertheless, the reason I brought up the bonds in this particular circumstance is to highlight the fact that they did not play a role. Nevertheless, I would expect that the bonds are going to come back to life this week, and that might be the driving force behind markets now kind of moving forward. As I was saying a moment ago, the SPX ended the week dead on the expected move, the upper edge of the expected move, which is a very, very efficient marketplace, and the Russel. I mean, this is something that really cannot be overstated. When I talk about, markets that are doing what is expected and efficiency of the marketplace, well, here's where I couldn't come up with a better phrase than the Russel marketplace has decided, of course, that Jerome Powell may actually be a demigod. The Russel, and this is, absolutely critical. This is like a 2 sigma type move here. The Russel isn't just outside the expected move. It absolutely blew through it. Okay. Now, it's important to denote this because the Russel has literally been kind of Mr. Toad's wild ride, breaching expected move, for instance, massively to the downside last week, this week doing the exact opposite to the upside. The opportunity inside of the Russel could be many-fold moving forward. We may actually move back in the Russel product to trades like back spreads. And the reason I mention that right off the bat here is back spreads work extraordinarily well when a product is not adhering to anticipated moves, meaning that, the options market, and I think the best way to kind of delineate this, the options market here, we opened at about 215. We're supposed to go up to, 220 and change. So the way to kind of explain this, there's the options market, looking for like a $5 move higher or $5 move lower. It didn't get a $5 move higher. It got a move all the way to 226, which is, from 215 to 226 plus 11. That's why I say it's, that's not one standard deviation. It's beyond even 2 standard deviations. And that is what becomes fairly pivotal when you're looking for a strategy. And what strategy might we want to deploy? Back spreads. And that's something that, most people don't necessarily think about when they see these huge breaches of expected move. But hopefully you do see just that. We'll embark upon a couple of different trade ideas in this, possibly early next week, depending upon what sign of movement we see in the bonds and overall trade action. Now, before I go any further, I mean, that just sums up the entire week. The entire week really broke down to one aspect. We were grinding a little higher earlier in the week, and then we just shot to the expected move. Week over and done with. There does not need to be any discussion of the Fed here. Listen, they will talk more about the taper talk in the very near future, but on on that, we're going to see movement probably in the bonds this week, and that's really what's going to drive the equity index markets. The next aspect I really want to cover on this weekend's update here has to do with some what I would term volatility abnormalities. One of the first things, and this is something it's come up a lot lately. I've had a few clients shoot me over. There was an article specifically about this, and it has to do with with volatility overall. If we take a look at the SPX, the options themselves, right? And the SPX, I always frequently call this the mother of all products. We're first going to talk about 1-year implied volatility. Before I go any further, I'm going to close up this left side bar. Just kind of follow along with me for a second. Look at the right-hand side of the screen that I'm actually highlighting right now. Now, as I highlight, there's 2-day options and 3-day options and 4-day options. They've just added so much to this marketplace. But the thing that I want you to be able to gather out of this is short-term volatility is appropriately dead. I mean, what are they pricing in for like Monday? 6% vol. And the further you go out, obviously volatility gets a little higher. What the marketplace is actually indicating on this front is it doesn't see a whole lot of risk in the near term, but of course that the future is very, very uncertain. And that's not abnormal by any stretch of the imagination. It's what we often term contango and backwardation. There's a little bit of skew out there. But what is rather unusual is how much volatility is actually packed into some of these back month options. Now, again, I just scroll down a little bit here and I highlight it once again. And when I say scroll down, now we're going to start, 82 days out. Now, we're not, suggesting that you trade necessarily out here, but look like a year out. And one of the things I wanted to highlight is a year from now, the volatility is, roughly 25%, which is an indication that the S&Ps, they're propositioning, if you will, almost 1,000-point move. And that's one thing that it should resonate with you, because it's that is abnormal. That back month volatility happens to be that high. You're looking like, if we talk about these expected moves, and last week there was like a $67 expected move, right? That was the expected move for a week. Here we have all right, so let's throw it in here, 1 year. And I'm just rounding this. It's going to be plus or minus close to $1,000. So for 1 year, the expected move is almost 1,000 points, which categorically speaking, in a marketplace with front vol, okay, and this is the abnormality, with volatility effectively, dead in the front expirations, there is just this tremendous amount of risk being priced into the back month, and all of the back months. And it's one of the reasons, obviously, we're still selling a lot of premium back here, but I'll discuss that in a few moments when we get some of the trade opportunities. But I can't stress this enough. It's something that, as a trader, okay, you need to be aware of. It doesn't matter whether you're trading stocks, options, futures contracts, that back month continues, when people look at this and they say, well, they're just ripping us off, out there. And okay, listen, it's a pretty efficient marketplace. If you think that these are overpriced, somebody would come in and sell them. If you think they're underpriced, somebody would come in and buy them, right? And there's categorically speaking, there's still humongous volume is traded out here. Don't think that these are illiquid options by any stretch of the imagination, even a year out. And again, I'm not suggesting that you need go out and trade these. Just, understand appropriately that the volatility about a year from now is almost 1,000 points, okay, being priced in of movement to the S&Ps. And if you look back again, historically speaking, when there's no front month volatility, when volatility in the front month is, 10% or 12%, back month usually drops down to, 18, 20% at best. What's it doing up here? It's, it's 25, 26%. And that, people, is a degree of an abnormality out there, which, again, we're actually going to show a way to take advantage of that here momentarily. Next thing on the docket here, short-term implied vol was absolutely crushed. And that's exactly what we're also kind of delineating. Short-term volatility is dead. It's absolutely dead. There's just, the one kind of warning shot I want to fire on this one is right in here. Selling options in here is an absolute, this is like a no-fly zone right now. If you sell options, okay, in the near term, you're going to get killed. And you're going to get killed because volatility is incredibly, incredibly efficient. Nothing delineates volatility and the efficiency better than looking at the expected move. What I'm saying is the marketplace, okay, expected a $67 move. Guess what? It got a $67 move, which means, this last week, if you look at implied volatility and then you look at realized volatility, which is known as historical volatility, these two converged perfectly. Fine line in between them. That fine line is actually the upper edge of the expected move. So you can't sell anything in the short duration. It's just far too efficient. There's no edge for you as a retail client. And I'll tell you what, there are some, some market making firms that do sell short traded stuff, but of course they're using algos to actually mitigate that risk, and it's crazy out there. So short-term volatility was also crushed. When I talk about short-term volatility for this, I'll actually bring up the VIX. So the VIX got whacked back into the 16 handle. The other aspect I really wanted to kind of resonate with you is that short-term volatility in this particular circumstance, that floor is probably somewhere around the 16 level. And I stress that again, when I say a floor in volatility, maybe we're heading into a little bit of a new, a new kind of paradigm in here, but if you look at some of the recent weeks and months when markets been hitting all-time high, the floor in the VIX has been right around the 16 handle, and it's effectively where we are, which does open up some VIX trades. I'm going to again kind of mention that here momentarily. I'm just pointing out a few volatility abnormalities to actually get into the trade opportunities. So realized volatility is absolutely still dead, and that's actual stock price movement. It's something I've mentioned just incessantly lately, is that actual price movement in the marketplace, okay, should be substantially higher than it basically is right now, and that should put you on guard, meaning that the QQQ or the S&Ps, all right, and the S&Ps are super efficient this last week, but the QQQ is just not moving as much as you would anticipate based on some of the implied volatilities out there. Last but not least, in terms of these volatility abnormalities, SKEW. SKEW is almost record. By the way, if you've never looked at SKEW, SKEW is only really calculated, and SKEW is a symbol. It's only calculated literally once a day, but pull up an area chart. We're recording right now some of the highest SKEW in the history of this business. So SKEW effectively means those out of the money puts in the SPX, they are juiced. Say what you will. And in this case, I'm actually going to cruise back over to the spiders just to make a quick point. I'll use the spiders because I think it's a softer, gentler product. Look at some of the back month options here. We're going to cruise all the way out to the December expiration. I'm going to snap into implied volatility. People, okay, just look out here. Like, I'm all the way down to the 317s. You realize the product is at 450. And again, I'm going to highlight this because it's of such critical importance of what SKEW really kind of means. So the product itself is at 450. I know I'm 100 days out in time. I'm 100 days out in time because there's almost 22 vol back there, right? Look at these 317s. These 317s, they're trading at 37% implied volatility. How many times have you even seen a 37 VIX? Okay, in your life? And it's not about the premium you're collecting. It's about the fact that the volatility is sky high back here because, traders are like Chicken Little. The sky is falling. The sky is falling. You know what? Right there, that's trade opportunity. And that's exactly what I'm going to get into next here is the trade opportunity revolving around, okay, SKEW, revolving around higher long duration implied volatility. What is the trade opportunity? First and foremost, premium selling continues to dominate the marketplace, just continues to dominate. I mean, if you're selling premium out there, especially into this SKEW, I mean, you've been completely and totally unscathed. There's no question that you have to actually mitigate your exposure. I am not suggesting, okay, that anybody goes out there and just, wax premium naked, meaning that you don't just go out and sell premium naked. You're out here, look how much juice, okay, is up for the squeeze. And I'm just rounding over here for a second. There's 450. These are the 350s. Okay, it's almost $2.50 a premium on almost a 32% implied volatility of a 7 delta option. Again, I know it's further out in time, but further out in time, people, it's where it's at. There's like no gamma risk out there either. But, okay, you're going to need to mitigate that risk. And lo and behold, so premium selling, as I say, continues to dominate. Like premium selling, we've just been like unscathed. You've taken in our TheoTheo portfolio, we've taken one loss on a year-to-date basis, okay, on umpteen different positions. And we can go through, and we've got hundreds of positions to go through right now. We've taken one hit, and that was because of a rally, specifically in the IWM early on in the year. But with premium selling, okay, you should know that the volatility crush, it actually opens up the hedge for us again too. If we take a look over at the VIX, I mean, it's like a catch-22. You have this really, really huge SKEW pumping premium into those out-of-the-money puts. But at the exact same time, what's really cool is that the VIX is inherently low. And the VIX is actually allowing us, okay, to use its SKEW in our favor, meaning that I'm actually buying VIX spreads to mitigate, all right, some of the risk of the premium selling. And this is actually what we discuss extensively inside of the ultimate premium selling class here, of course, at TheoTrade. And I bring this up because, never before have I had it like this well. Like, this is exemplary of premium selling. You're getting a crush in the VIX. You got SKEW sky high. You got back month vol that's just jacked. Like, if you're not selling premium right now, I'm telling you, you're completely missing the boat. Okay, that is one of the biggest trade opportunities we've seen. Again, that volatility crush just opens up to make it easier. Now, I'll switch gears on you for a second. I also see some opportunity here for those of you that want to be directionally inclined. FXI, but more appropriately, stocks like Alibaba. Alibaba, if we take a look at like auto expected moves, this thing has just been smashing outside of what the marketplace is expecting. Okay, it's ripe for the plucking. This is one that I'm very likely to do a type of back spread on. In fact, I was even analyzing a particular trade in here. I will look to do some back spreads and so forth on here. Now, this is a bullish back spread. It's a bullish back spread for a product that's just been getting, annihilated. Forget about the expected moves and the stats behind it. If BABA is to explode back to the upside, even like the 200 level, the trade would be incredibly profitable. In this particular circumstance, worst case break-even point is about the 190 handle. Do you think that Alibaba can get back to 190, in the next couple of weeks? Absolutely, unequivocally, sure. But at the exact same time, I'm putting the trade on for like a 90-cent credit. All right. And again, I've got all kinds of cool trade opportunities right now that are opening up because SKEW is beneficial, right? And that's where it's at. And again, Alibaba looks like it's going to be a fairly decent candidate. And again, if Alibaba continues to crash and burn, I'm still going to keep my 90 cents in this particular back spread. Lots of trade opportunities that are opening up in this marketplace that you're like, oh, it's rallying again. There's nothing out there. There is. Last but not least, of course, in this weekend's update, I always mention the SPX, the expected move. If you're not into the understanding of expected moves, will you get into it? Because this has been the most efficient marketplace that we've seen yet. Now, in this particular circumstance right here in the S&Ps, all right, last week we were looking for a $67 move. What was the move? On the button. This next week, we're looking for plus or minus approximately 57.49, and that's exactly what this upper and lower line kind of delineate. And these are hand drawn, and the reason that they're hand drawn is for accuracy. I literally hand draw these, on like a Friday night and peg the expected move. So we're looking for a $57 move to the upside, $57 move to the downside. And I'm going to tell you something. This next week, as I said, I think that this expected move is going to rely very heavily on bond trade. Bond trade's about to come back to life. With that, you're very likely to hit the upper end or lower edge of the expected move in this next week of trade. So get ready to rumble. They've crushed volatility. There's some opportunities, but those opportunities reside in some of the back month premium. Keep that in mind. Some trade opportunities that have really opened up, and I'll be executing those early on in the week. Again, game-changing rally? Absolutely, unequivocally not. Just par for the course. We hit the upper edge of the expected move. We'll move forward with some of the opportunities that this market has presented. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.